Welcome to the September 2025 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at Motor Capital Management. The name of the video this month is Yes, it is a bubble, and that's a good thing. So there's a lot of talk about whether or not this is or is not a bubble, and I think particularly the veterans who have been in the business for a long time and are insisting that it's not a bubble. They know better. That's my belief, and I think they probably have ulterior motives for insisting for why they insist that it's not a bubble. But be that as it may, I think the evidence seems relatively clear that we're in a bubble. But we're going to discuss that and discuss why there's a hesitance or hesitancy to acknowledge the idea that we're in a bubble. But we'll talk about all of that and what we're doing about it as we go through the video. So, with the Fed having pivoted towards a more accommodative stance, equities have absolutely steamrolled higher through the month of September to finish off a very, very strong third quarter of the year. And this all despite warnings about bearish seasonals. The market has a tendency to do that. So, as the S&P has hit new highs recently, what we're finding is that the leadership is becoming more risk on, which of course is a good thing. But it's broadening out to include small caps, cyclicals, and critical to our thesis, this notion of innovative new era growth. And so if we're right about this notion that we're transitioning into the hype phase of a bubble, then we should see this continued strength from these areas of the market, narrowly focusing in these speculative themes. So hype phases tend to be they tend to be much quicker than the fundamental phase, which can unfold over a number of years. Hype phases are measured in months, and I think that's what we're stepping towards, and we'll walk through that as well. So we're fully participating in this market environment, but we have exposure on both sides of this condition. We have exposure in both the hype phase winners on the long side as well as the old economy losers on the short side. So before we get into all that, let's just quickly take a look at the S&P 500 itself. When you look at it, it looks, quote unquote, looks fine, and there's really nothing really to say negative about this. The S&P is hitting new highs. Hard to argue against that as a being a positive condition, but I want to point out what is painfully obvious is that, and that is that that's pretty much what it looks like all the time as it heads into the top. And so I'm not saying that we're there yet, but I think that what it looks like at the peak is not necessarily going to be helpful. What's going to be more important is what it looks like beneath the surface. And the last time it looked fine but was rapidly deteriorating beneath the surface was the latter part of 2024 and early 2025, which actually got us to our first short exposure since 2023. We don't see that yet, but just because it looks fine today doesn't mean it is fine. And this is one chart that I think is pretty does a good job illustrating the disconnects I'm talking about and have unfortunately been talking about for a while. But more recently, this is the S&P breaking out to new highs over here, and we can see that up until right up until here, the advanced decline line was participating in basically since this momentum surge here ended, and the market kind of took on more of a more prodding, sort of methodical advance from there. Note that the advanced decline line began to taper off, and it's starting to falter to the downside. This is the advanced decline line on the New York Stock Exchange common stock only, so it's a very broad breadth measure. But nonetheless, this is the advanced decline line, and you can see um, the last in the latter part of 2024, as the S&P again broke out to new highs, the advanced decline line was diverging. And so we think that's that's typically what tactical highs look like, and we are concerned about this, but we're not overly concerned just yet. Down here we have the McClellan oscillator and the summation index, and you can see once again materially diverging, which it did back here as well. So keeping an eye on that. The way that this really kind of manifests is through this chart that we've been talking ad nauseum about for quite a while, but it is what it is, and it's just descriptive of the environment that we're in. And the more we see this type of behavior continuing, the more we just become grounded in our thesis that this is just this has been a bubble, and it's just getting more and more narrow, and that sort of feeds into our hype phase bubble, which we'll talk more about in a moment. But here again, we can see that this is that peak in 2024 into early 2025, and you can see the divergence shaping here. And then even at the very tail end of it, where we eked out a slight new high, we get a divergence right here as well. So off of this low here, we've had strong movements higher from both the popular average, the S&P, and the average stock, which is how things are supposed to work. These two averages are supposed to move together. More recently, however, we can see that we've had this bit of a wedge formation on the value line geometric average, and it's actually broken down out of that wedge in stark contrast to the S&P 500, which is hovering just near its all-time highs. And with this breaking down here, excuse me, this potentially cements this bigger divergence that we've been covering. So we've been waiting for this to either resolve higher this way and just kind of break out and kind of get the bull market going, or to break down this way to cement this as a bigger picture, longer term divergence. And unfortunately, it's not etched in stone yet, but this is certainly moving in the wrong direction. So not something that we're overly concerned about just yet, and I'll show you why. But nonetheless, it is what it is, and we want to keep a close eye on it. So, despite this, the poor breadth conditions um, in the market, what we can say is that the leadership remains risk on, which is obviously a good thing. So first, when you look at that value line geometric average, what that's telling you is that there are, as despite what the S&P is saying, there are a lot of bad charts out there still, and that might be really difficult to comprehend or imagine that that there could possibly still be bad charts, but that's what this table is all about, and this is what we're updating each. We update this throughout the week in our weekly motor reports and CMIs, but certainly try to cover it in more detail as well in these monthly videos. But this is the short-term weekly trend, and we're taking 2,900 stocks and breaking them into 6 trend buckets, and they go anywhere from uptrend to a base of an uptrend to a downtrend to a base and a downtrend. And that's what you see here in these 6 buckets. And the benefit of having those 6 buckets aligned is now you can put every stock into one of those buckets and then see how the whole market shapes out. And when you get down here at the market level, 60% of the weekly charts are in some form of uptrend, meaning they're in one of these 3 buckets. So when you add up these 3 buckets, you get 60%. Now, the good news is that's a majority. It's more than half of the market looks something like either this on the weekly chart or like this in a worst case scenario. In and perhaps even better news than that is the fact that the biggest trend bucket of all 6 of these buckets, which is why it's colored in blue, is clear uptrend. And that means that the chart looks like this. So it's the biggest bucket. Now you'll notice that it's the biggest bucket but not by a large margin. An up base negative, which is a base in an uptrend and it's oversold like this, is pretty close as well the clear downtrend, which on the weekly chart would be charts that look like this. So currently, 23% of the market, believe it or not, with the S&P out to new highs, looks like that. And if you go through these charts, you'll see them. They're pretty bad charts. And then in addition to that, and again underscoring or revealing why the value line geometric average looks so bad, 62% of the monthly charts are in some form of uptrend, which means that 38% of the monthly charts look like this or this in a best case scenario. So again, it's not bearish. These are in the majority, and especially when you look over here on the monthly time frame, the biggest bucket in all but 3 groups is clear uptrend. So that's very strong um, trend structure from that perspective. It's just unfortunately that when you map it out to the all 6 buckets, there's still only 62% in an uptrend. But what this does mean, where you have this many groups that show the majority of charts, the biggest bucket of charts to be charts that look like this, what that means is that if you're worried about eventually the market looking like this over time, if this all unfolds classically, which we have no reason to believe that it won't, what will typically happen is that these charts will first go through some sort of distribution process, which is back and forth like this before it heads south. And remember, this is the monthly chart. So that span of time I just drew is months, right? So that means that the next oversold condition will be a buying opportunity tactically, because typically you don't go from here to here. You first go from here to here, which is a base a base of an uptrend but oversold, and then back to here, and then perhaps you go back and forth here a couple times, and then you go here. So this right here, this back and forth is the distribution phase. We have all of that ahead of us. So that's why you can't be bearish. And one thing I want to stress is that unless you have concrete reason to be bearish, you shouldn't be bearish because that's what the historic data tells us is that over time the market goes higher. So unless you have really compelling reason to be bearish, you should not be bearish. And while this is not robust table pounding bullish, it's not bearish, and so therefore you should not be bearish. Um, so let's focus on the leadership. So when you look at these top uh, 15 groups of the 29 groups, again, with the exception of maybe legacy media and utilities is kind of a difficult one to say now because obviously there's a lot of AI um, emphasis there. And then, of course, insurance is a pretty safe, low volatility safety group. So those three are in the leadership, but beyond that, it's a very cyclical, growthy, new economy, new era type leadership. And again, this is just between these two things. This is in the majority. And there's a lot of uptrends in the monthly charts between that and the fact that this is still quite bullishly leaning from a leadership perspective. This is just not evidence that you want to be able to point to say that this is why I'm bearish. This certainly fights that notion. So all of this together, when you pull it all together, bubbles up, if you will, no pun intended, or perhaps it was, into the risk gauge, which again you can see that it's really struggling to embrace a risk-on, strong bullish environment, which would be revealed by these long-term and medium-term uh, risk gauges on the equal weighted sort of like a breadth perspective into the risk on categories or readings. And we've actually gotten a number of clients who have asked us, how is it possible that the risk gauge is not in risk on, given that the S&P is breaking out to new highs? And I think all the data that I just showed you that underscores the divergences that just keep uh, sort of permeating the underbelly of this market. I think that's what the risk gauge is trying to warn us of, and just let us know that this is not a risk on, pure risk on, all is clear type of a bull market. And just to demonstrate that the last time that we had all three of these in risk on was 2020 to 2021. So trust me, the indicator works. The risk gauge is functioning just fine. I go back and look at all the charts that are, according to these models, are still in downtrends just to confirm that they indeed are. And yep, they look just as bad as the indicators say they would. And I just want to stress again that, and I'll talk about this in a moment, but in this environment, this means that you should be able to have some short exposure on. And we have lots of short exposure on right now, and it's actually doing quite well. It's actually serving quite an important purpose, which I'll again talk about a little bit more in a moment. But there's in a really strong, robust bull market environment, which is an environment where rising tide lifts all boats, it's extremely difficult and very hazardous actually to find and try to engage with short exposure. But today we don't have that problem. There are so many charts that are breaking down in long-term time frames, and again, that just is being, I think, very consistently and effectively revealed here in the risk gauge. So this is where we are. Again, it's not bearish, at least not yet, but it's certainly not an environment where you can just be fully risk on with no short exposure or no sort of concerns of what the market might look like in, say, 3 to 6 months. So This is the a snapshot of the soon to be released dashboard on the website. But um, what we're able to control for here is the look back period. So what we're doing is here with this being September 30th, looking back over the past quarter to see what the market did, and then B what led the market in that effort. And so what we can see here is that the median stock in the 2900 motor universe, 2900 stock motor universe was up 6% roughly. And the average stock was up nearly twice that amount. So that gives you the effect of the skew, if you will, on the upside. But nonetheless, even from a median perspective, it was a pretty robust, strong market. But once again, here we go. Only 64% of the stocks advanced. So there were a lot of stocks that went down over the course of the past quarter, despite the S&P going up, despite despite even the median stock being up 6%. There were lots of stocks that were down. Now, rounding out the top, the leaderboard here is precious metal. It's just incredible. In the long-term momentum score, it retains its one, but in that very short-term tactical time frame that we really lean heavily on for our tactical trading ideas, it's even still a one there. So this is just not giving up the ghost anywhere. And it was up, the median stock was up 48%. And as I'll show you in a moment, the worst performer was up 12%, thereby showing you that 100% of all precious metal stocks last quarter were up. But then again, with this table being sorted by the median change, you can see that what won in the past quarter was largely very strong, and good to see biotechs in there as well. And it's important to note that biotechs aren't just leading in the very short term; they've actually turned the corner quite a bit in the long term. It now ranks number 5 in the long term, so that's a legitimate, strong move into leadership. So when you look at the winners over the last quarter. This is just a really great place to shop for ideas. Take a look at these charts, perhaps screenshot this while we have it up, and you can see the the the, s- the very short-term momentum scores. So what you're looking for are from a tactical trading perspective, you're looking for ideally strong long-term momentum. You'll see a couple here that aren't strong yet. But you're really looking for strong, very short-term momentum, and then leadership stocks within those strong industries. And so here's your momentum score for each of the stocks that are featured and how much that stock was up in the past quarter. And then when you look at the leaders in the top 5 winners in the precious metal space, it was just on fire essentially. But again, as you go down this list, there's just so many good um, trading ideas. We're long a bunch of these things, and we featured a number of them in the trading in the new motor trading portal as well, swing trade portal. So on the flip side, of course, there's these are the 5 worst performers over the past quarter in each of the groups. And here again, here's precious metals, and the worst performer was up 12%. So that is a strong group. Now I'm going to put that into context a little bit. It's been strong for sure, but perhaps it's been a little too strong. But clearly it's leadership. It won't even give up the ghost in the very short term. So probably need a little bit of take a breather in here for a bit, but nonetheless, it's still very very strong. But what I want to really highlight on this in the top 5 is that there are a number of really bad charts here that went down quite a bit last quarter, underscoring this notion that there are as strong as the market looks. It's not nearly that strong beneath the surface, and therein lies this notion that there actually have been and continue to be a lot of great short opportunities setting up as well. So when you look at the motor industries, which are one step down from the motor group, so this is a table that lists the best performing groups. Uh, sorry, the best performing motor industries. And a couple months ago, I had written a note, and it was in and around the time when I wrote about uh, a bubble from an easy chair and an easy fed chair basically. And I had highlighted a number of industry groups that I thought could offer leadership in a very speculative way as we transition this market towards the hype phase of the bubble that I believe we're in. And here you see them. You can see most of those industries that I highlighted back then are absolutely right there in the hunt in these very short-term momentum scores. So from a tactical trading perspective, I'm comfortable shopping anywhere in these industries, but I especially like to hunt in uh, these more sort of hyper growth, new era type of industries because this is where you really see that sort of speculative froth. I mean, if you're going to embrace a bubble, then let's embrace that bubble. And this is, I think, where we're going to find it. Certainly, it's where we found it last quarter, as I just showed you, and I think it's where we'll continue to find it as well. So, just a quick perspective on gold and gold stocks. So, this is gold futures, and this is the momentum score. The Z score, I should say, on the momentum of the precious metal, and you can see that this is the median. This is if the indicator was here at this dashed blue line, that would indicate that it's kind of experiencing its sort of average momentum over the past 20 years. And then you have one standard deviation and then two standard deviations to the upside, and then one and two standard deviations to the downside. And what we see here is that it's now above two standard deviations. And the way this indicator is presented is wherever it is presently, it also draws a dashed line across to the left so you can see its present location in the context of its history. And you can see here that it's quite extended. So there's nothing wrong with this chart, but it never looks like there's something wrong with it at the very, very peak by definition. And so by no means saying that it's over, but clearly putting this in context that it's getting to the point where taking a breather would make some sense. And then lastly, just focusing on healthcare because I think it's important to put in perspective what's been going on in this sector for the past 25 years or so. I mean, this just very quickly to point this out, this is the relative performance of healthcare uh, more recently, but even over the past 25 years, it's been it's had its moments in the sun, of course, and this was we were back in my former role, we were very long healthcare and biotech in particular, which you see down here. And but that was really the last shining moment for the sector in the past 25 years, 26 years. And so if this does manage to put a turn in, and we're starting to see some indication of that with healthcare services and pharma starting to work their way up the list, this is sort of the backdrop behind that potential relative performance turn, and therefore, when you back test looking for 10 baggers over time, and I've done this work, the one of the sectors that shows the highest prevalence of 10 baggers is actually healthcare. But surprisingly, it's not biotech because by the time a biotech gets to the point where it's got that promise of becoming a 10 bagger, somebody steps in and buys it out, and one of the larger companies buys it. So there's actually not a lot of 10 baggers in the biotech space. Of course, there are some, but not nearly as many as other sectors. But more broadly speaking, within healthcare, there are lots of 10 baggers. And so this is a sector that typically produces some really great economic outcomes that has just really suffered over the past 25 years. So potentially, we'll be looking as 26 starts to get underway for a potential turn in healthcare. And if that's the case, then we will anticipate that we'll see a strong participation from biotech, which also is not done very well. This relative performance line is biotech versus the sector itself. And again, this right here was an epic biotech run. Back in the day, we had roughly 30% of our fund invested in biotech. And again, as you can see here, that was pretty much the last time you should have owned biotech. And so we're not there yet. We as I showed you earlier, biotech is now number 5 on the momentum score. So there's very strong promise for this eventually going this way. And if that ends up being the case, then you can rest assured we'll be featuring a lot of those in the swing trade portal. So let's move to this notion of bubbles, and I think probably the the greatest hallmark, there are many of them, of a bubble is valuation itself. And what we're looking at here is back to the 1940s. This is the S&P 500, And this down here is my version of valuation, and all we're doing is taking the best fit line through earnings through time and using that best fit line to represent earnings and trying to because earnings over time look more like this. They're very cyclical. We're just taking the best fit line and using that best fit line to calculate the PE ratio. And when you do that, what you can see is a couple things. Uh, the median PE ratio kind of shoots through the 17 area. And so that's kind of, I think most people would agree that people would agree that that's the generally accepted notion of what fair value is. But I think the truth is you can see that there are two valuation regimes here in actuality. And we can argue whether or not it makes sense that we've kind of stepped up into a higher re valuation regime here where what used to be considered expensive is now considered cheap. That appears to be what the market is telling us. But even if we accept the notion that this is just we're in a new elevated regime, current valuations are clearly in nosebleed territory. So this is a very good hallmark of what a bubble might look like. But as we're indicating here, in the last bubble, this is the 1999 bubble into early 2000, the internet bubble. This right here in 1996 is where Alan Greenspan, in one of his testimonies, asked the question, how do we know when irrational exuberance has unduly escalated asset values? And what he clearly demonstrated by asking that question when he did is that we don't know. Because when you look here, he made that comment right here, and valuations doubled, and the stock market doubled. So, uh, it's valuation is a tricky thing in terms of using it as from a timing from a timing perspective, but it does provide great context and descriptive value in terms of whether or not you're in a bubble. So this did tell us we were in a bubble, and I think that's what he was trying to tell us. But it didn't mean that the bubble was over just because it's expensive. And while we're getting up into the nosebleed territory of the 1999 bubble, which leads me to believe that we're kind of getting to the late stages of it, i.e., the hype phase, as opposed to what I'll describe in a moment, the fundamental phase. I think we're getting near it, but I do think it can spill over into 2026, perhaps dovetailing with the end of the current Fed cutting cycle. But we'll see. A lot of postulation there, which it has no value. So last chart here, just to kind of bring this all back into context here. This point in time here is where Alan Greenspan uh, uttered the phrase irrational exuberance. So what we're looking at is a chart that goes back to 1995, and this blue line here is the S&P 500, and the green line is the S&P 600. And what I want to use this chart for is to draw this distinction between what I refer to as the fundamental phase of a bubble and the hype phase. So I believe that the fundamental phase is something that takes place over time. And it's basically when the market is waking up to this notion that there's this world-changing technology coming down the pike that investors need to kind of figure out which stocks are going to benefit. And so they just start pouring capital into the established companies. And so you end up with companies like back in the day here, you had the established companies like Oracle and Microsoft and of course Cisco being probably the Nvidia of the day back then. These things were trading at 40, 50 times revenues. And the idea was that there was these were the clear and obvious plays on this new internet phase. And the reason we struggled back then, and today we struggle today to call today a bubble, but the reason we struggled back then to call it a bubble is because these are established companies. And uh, the idea is that because these are established companies, it can't be a bubble. But I think we just need to properly phrase it so that we can put this in proper context because it was a bubble. It's just that back in that phase of the bubble, in the fundamental phase, you're taking valuation risk. You're not taking business risk. And it's in the final hype phase of the bubble where we transition from not just taking valuation risk, but also now taking business risk. And by doing that, what we're doing is we're migrating to small cap exposure in companies that are not established, managements that are not established. Some companies don't have earnings, and many don't even have revenues. And so, what I want to point out here is that in this hype phase of the bubble in 1999, you'll notice that in the very last part of the bubble, small caps outperformed, or probably the way to say it here, given the direction of the trend, is that large caps, the things that got us to the party, began to actually underperform. And that was a function of us moving toward those small, hyper growth, new era, new economy stocks that just absolutely blasted off. And that ushered in the hype phase of the bubble, and it was within a period of months, not years, that the bubble finally came to an end. And when that transition happened back in '99, the I think one of the most important things to point out is that that transition ushered in almost like a period of normalcy, where small caps actually outperformed. Oh, maybe again because of the way the chart is drawn, where large caps underperformed small caps for 20 years, and all of this came, sort of kicked off first by the hype phase of the bubble, but those were a different set of stocks. These were stocks that were not established internet plays, companies that changed their name to .com, etc. But what I want to point out is that when the internet bubble actually peaked, you'll notice that the small cap index actually went out to new highs a couple years later, and that was after 9/11. So I'm open to this being the case, but what I actually think is as we move forward is that as this phase played out here, I think we see the same thing play out here. And so I think, not to say that I'm 100% confident that the fundamental phase of this bubble is over. But I do think that we're starting to see a lot of indications that that's the case. So we're seeing a lot of companies today announce that they're going to become a crypto treasury, and they'll go up 1,700% a day. We've seen five or six or seven of those over the past couple of months, and that's very reminiscent of, hey, I'm a .com, and all of a sudden my stock was up 500% back in '99. We're starting to see a lot of that. So that's just more information to me and more evidence to me that we're starting to transition away from the fundamental phase where the established companies that we know and love and respect got us to the party. And to ride on that bus, we had to take valuation risk, which is what we've done. We had Nvidia up to 50 times revenues at one point. We have Palantir trading at over 100 times revenues at this point. So up until now, we've got established companies where we're not really taking fundamental risk because these are good companies, but we're just taking valuation risk. But from here, if I'm right about what's coming, this begins to turn down as those companies start to actually underperform these hyper nuclear plays and crypto plays and raw material or batteries in these other newly established, quite frankly, industries, in drones and robots and space and all these things that are just unproven. They're going to go up so much that as good as Nvidia looks, it's just going to underperform. And back here, that's what happened to Cisco. Cisco started to underperform in this phase, just as I think Microsoft and Apple and others will start to do in this phase as well. So this is kind of what I'm looking for. And again, yes, I believe it's a bubble. It's just we've just been in the fundamental phase, which is why it's been hard to label it a bubble because they're all established companies. But I think that's in the rearview mirror. And I think what is coming ahead is the hype phase. So just to summarize that whole idea, so we think that we're entering the hype phase of the bubble that will last into 2026, and that might dovetail with the end of the Fed's current rate cutting cycle. So while these new era leadership companies and industries will likely continue to dominate this hype phase, it's good to see these old school biotech is starting to make a stand as well and starting to broaden out away from just these AI plays. Although obviously we can make the case that biotech is certainly an AI play for sure as well. So the notion is that when you hear the phrase bubble, the tendency is to want to run away from it. But I would actually say, like this dog is doing for us, demonstrating, you actually want to chase it. You want to actually run towards it and embrace it. But like the '99 internet bubble, we also have a lot of short exposure on today as well because there are just so many bad charts. And I'm not talking about hourly charts and daily charts. I'm talking about monthly and quarterly charts that are just kind of rallying right into the kill zone of where you want to short these things. And I think in this environment, you should have exposure to the bubble phase, the stocks that are in that sort of hyper phase of their bubble, because you can do quite well in that moment, as I just showed you on that quarterly summary table. But you can also source a lot of great short ideas, and there's been a lot of great things to be short in the past 3 months as well, and I think that's going to continue into the fourth quarter in 2026. The big point, the picture though, is that eventually, and I've been saying this for a while, which underscores the notion that you have to be patient and keep all of this stuff in perspective and make sure you're operating in the context of what's happening right now. Don't forecast anything, just stay focused on what is right now and do that until it's not. So ultimately, I think that this is going to set up to be an epic short opportunity. But in the meantime, it's going to be critical that if you're going to participate in this bubble, to stay on the bus as long as it's moving forward. And more importantly, if you don't want to participate in it, do not jump in front of the bus because this can go up an awful lot before it's ready to go down. And so that's a major takeaway for me in regards to the conditions that we're experiencing today in this market. So that's what I got for you this month. As always, thanks for joining. And at any time you have any questions or you want any information on the service or the new swing trade portal or anything like that, please at any time feel free to reach out to me and at the email you see here, and I'd be happy to help. Thanks so much.